and welcome back to Dukascopy TV. In the studio with me today is Roland Duss from Gonet Cie to discuss financial repression and its impact on financial assets. Roland, hi, thank you for coming back into the studio again. Now, Roland, the term financial recession is one that we're all familiar with. However, financial repression, can you elaborate a little bit on that for me and how it's being exercised at present?
Okay, financial repression is basically a term that describes the state of the financial markets. It described it during the big depression of the 1930s, and it was also used for during the period 1960 to 1980, especially in the UK. The general idea is for governments to be able to fund their deficit, to channel the savings to fund these deficits so as to decrease basically their burden, their interest burden, as well to decrease their ratio of debt to GDP. This context is highly actual, as you know. Even the US is having a huge deficit of over 100% of GDP, and the European mess is known to everyone. So basically, the general idea there is to take measures, concrete measures, to channel savings, and ideally to have some inflation as well, because inflating the debt is basically the truth of the matter, since people do not like austerity. So concretely today, financial repression is more seen through the action of the central banks. Both the Fed and the ECB have decided basically to provide unlimited amounts. They have been forced to provide unlimited amount of liquidity to the banking system. Basically, this money stays with the banking system, but the use that is being made through the regulation of the banking system is, of course, to purchase the public debt. And that's exactly what is happening right now. Other measures that are taken are, of course, to force insurance companies to do the same, to force also institutional investors to do the same through regulation. And basically all of this has the advantage for the governments to say, okay, fine, I can fund my deficit and I'm okay.
If then, given sort of the current global slowdown, we can expect financial repression to continue for a long time, how does this directly impact sort of financial assets?
Well, there are several channels basically impacting financial assets. First of all, the quality of bank assets is decreasing, no matter how. Second of all, the inflationary risk becomes greater. Third, of course, low interest rates mean that investors are forced to take more risk in order to get some sort of a decent return. And basically, all these measures have had a tremendous impact on the behavior of investors so far this year, and will continue basically to impact the investment behavior.
So you mentioned there investment behavior. How then does one sort of invest around this heightened risk?
Well, there are several solutions, and the first one is obvious, is of course to purchase what we are being asked to purchase, i.e. For Europe it's very easy. When the ECB said I'll buy unlimited amounts of 1 to 3 year debt of Spain and Italy, you have to buy that, because then you know you are basically safe. You have somebody which will eventually purchase it and which will provide you a decent price for it. Second way around it is, of course, for institutions to look at credit rather than duration. The third thing that has been looked upon this year is basically corporate bond of companies of good quality, and this has also seen lots of inflows, and interest rates have decreased drastically as well on this class. The next thing that is interesting for investors in this context that is going to last is, of course, go for safe dividend plays. So you go in the equity market, you buy the Nestle, the Procter & Gamble of the world, you'll have your dividend, with some luck even an increase in dividend every year, so you have stability. Of course, then this context is generating inflationary fears, because money is unlimited. And in this context, the real assets have a role to play. The first one and the most obvious one is, of course, gold, because gold is getting back to a currency because it's not backed by debt, it's backed by real physical gold, and you can't multiply it. The second real asset that is being propelled right now is real estate. There you have to be highly selective. For instance, in the United States, the market is showing signs of revival, and this is basically a nice place, a nice field to play. And you have so-called REITs that distribute almost all of their profits in dividends, and you have very interesting yields. And also, of course, these assets have been asked for this year by investors. What about currencies? What about equities? Equities are going to fare well in this context because basically there is less uncertainty on the financing of the public deficits. And then as far as currencies are concerned, safer currencies are going, of course, to be better off, i.e. the yen and the dollar, than those which are directly impacted by the financial crisis, the sovereign debt crisis, like the euro. Of course, there the question is how long can the ECB sustain? How long can these deficits be sustained? Because one of the weak points of this money creation is, of course, that governments are not really enticed to take measures to contain those deficits, and that's a setback that could, of course, sooner or later penalize again the euro.
Roland, that does bring us nicely round to the Dukascopy question, in which we ask each of our guests if they had $1 million US, which instrument would they place it in for just 1 year? So if we take a look at the options that we've got for you today, we've got real estate, equity, you've also got bonds, gold, cash and oil in there. So Roland, where would you put that $1 million US for 1 year?
If I had only one choice, it would be gold.
Gold, you are our gold man, that does make sense. Why at present gold specifically then?
Well, gold specifically again because inflationary fears are there. Inflation is bound to come with all this money that is floating around. The problem is inflation will not come through labor because there is too much labor. It will come through commodities. And one of the commodities to really play the inflation is gold. The next thing is gold's demand is concentrated for about 75% in emerging markets. They like gold, they are going to buy gold, their central banks are going to buy gold, and it's basically a safe asset. It has a store, it's a store of value, and basically it's investors like gold as well because it diversifies nicely the portfolio. It has had a good return, it will keep having a good return with less volatile returns than equities or any other asset class.
Roland, always a pleasure speaking with you. Thank you so much for coming in.
Thank you.
We'll be back next week with more exclusive interviews. For now though, goodbye and have a great weekend.